Welcome back for the afternoon session of the Web3 Banking Symposium today. My name is Benedict Orban and I'll be the host for you in the afternoon as well. I'm the board member of the Crypto Valley Association and proud to represent also the board here on stage. First of all, before we go into the first keynote, I just want to make sure for those of you who are not from Lugano or not very often here in Lugano, who has heard of the Satoshi statue here in Lugano? Who has heard about it? Okay, not many. Right, 1/3. So there is an amazing Bitcoin Satoshi statue created by the Satoshi Gallery. It was actually published and brought to life last year in October at Plan B conference. And guess what? It's literally around the corner. So if you walk to the lake and turn left, you'll actually find it. But it's actually also, there is a pointer on the Google Maps. So go check it out. It's very interesting. If you look at it from the side, it's a person sitting and on his laptop. If you look at it from the front, you actually see through, and Satoshi himself disappears. So that was just a little thing. It's a very nice thing, and first one here in Lugano. So go and check it out if you need to take an afternoon walk. But let's start our afternoon session, and I can bring you an amazing keynote brought to you by a person from PwC. The topic is Crypto Asset Reporting Framework, CARF, Navigating the Crypto Reporting Obligations. Matthias Staubli will be speaking to you in his keynote. And just to mention, PwC is and has been a corporate member of the Crypto Valley Association since years, and this session shares valuable, tangible action items for all of you and for all of those who are obligated to follow the CARF. So with no further waiting, let me welcome Matthias on stage. Please put your hands together.
Thank you. Thank you very much. Good afternoon, everybody. So happy to talk now in 20 minutes about everything you need to know about CARF. It's a bit a challenge, so let's focus on a few cornerstones which are really important. When I designed the presentation here, I had a bit the feeling, well, okay, now we have the full morning where we have very interesting, enthusiastic speeches about the future in the crypto space, and now comes the tech guy or the technical guy, the legal guy, and talks about, hey, you have to do a reporting. What a nice start in the afternoon. But that's the reality, and transparency also has some benefits. It gives trust, and it can also help to further grow an area. So where are we coming from? What is this CARF, this crypto asset reporting framework? What we need to know is we need to look back in the past. And when we look back a few years, maybe some of you remember the situation we had with the Swiss banking place and the US government, the money which has not been taxed, the Swiss banks who have maybe not supported US taxpayers to hide the money. So that's basically where the whole story started, right? And then the US had the idea, hey, we want to have the information. Dear banks, you have to provide us all the information about your account holders, because we want to know who has money where in order we can tax it. So that was organized. Then on the OECD level, some countries also had this idea, well, if the US is getting all those information to increase the tax revenue, why we are not doing the same? Because also we think that people are not disclosing everything they should do. So what they did, they basically copy-pasted the FATCA regime from the US guys, translated into something more global, more broad, and created the automatic exchange of information. And the automatic exchange of information was targeting banks, insurance companies, asset managers. They all need to report on traditional financial products. At some point a few years ago, the OECD realized, well, there is something new, something with crypto. And people are not putting that in the tax declaration. So we need to change that. So they came up with the crypto reporting framework. And as you can see on the map here above, there are quite a few countries already joining the club in implementing it. And it's a clear goal of the OECD to roll this out worldwide. It has been declared as an international standard, which means the countries should and have to implement this. Now, what is a crypto asset service provider? Well, the definition we can read up here sounds quite simple. It is an entity or an individual that, as a business, provides a service effectuating and exchange transactions on behalf of a customer, a client, by acting as a counterparty, intermediary, or making available a trading platform. So that sounds quite easy, quite handy, but the devil is in the detail. And usually if I try to explain who needs now to do a reporting, I always say we need to distinguish between two things. And that's the left-hand side and the right-hand side on the slide. If you first focus on the left side, we have someone that could be an entity or an individual, and they offer a service. And this service helps a customer to exchange transactions. This could be acting as a broker, as an agent, as an intermediary, operating an ATM. Those are all activities would fall into that space. That's kind of okay. We can handle that. We can understand that. The more complicated side is the trading platform. Because there the OECD just said, well, it's basically everything which allows a user to trade. It can be a software, it can be a tool. It's not clearly defined what it is. So it's clear if I'm operating a platform where clients can trade, I am a crypto asset service provider. But we also have the DeFi space. How does it work there? The current understanding of the OECD is, well, if we have no one who is actually in control of the platform, we still have somewhere someone acting as a kind of a gatekeeper, making that platform available for a user, a client, offering it as a service, and that person should be the reporting person. That's quite interesting in the interpretation. And it's even more interesting if you take it into the more broader view with the US, where we currently have the discussion that they want to exclude the DeFi space. So it's interesting to see now what is the OECD doing, and even more interesting, how will DeFi be defined? Because at the moment, there is no official definition in terms of the crypto asset reporting framework, what falls under a platform and what not. So let's assume we have now considered, yes, we might be affected by it, we might be a crypto asset service provider, but we are not only resident in Switzerland. We might have a branch in another country. We might have a branch in the US, we might have a branch in Dubai, wherever. Now there are nexus rules, and those rules are quite tricky and quite mean somehow. Let's take one example here. Could be we have the entity A in jurisdiction A not implementing CARF. You might have a smaller branch in Switzerland implementing CARF. The result is that the Swiss branch will have to report all transactions also from entity A. That can be quite cumbersome. So that's something which needs to be analyzed and should be taken into consideration. Once we have agreed on that we have a reporting obligation, it's the question, what should we report? Yes, it's called Crypto Asset Reporting Framework. But what the heck is a crypto asset in the definition of the OECD? We can take this wonderful definition up there, a digital representation of a value that relies on cryptographically secure distributed ledger or similar technology. I think the good thing today is I don't need to explain to you what this is, right? Sometimes I need to start with a definition, explanation, what is that at all? But still, it gives some questions because the OECD took a very broad definition. And then they said, well, okay, it might be a bit broad, we don't need everything, because we also have the traditional common reporting standard. And we are amending that as well, because we're including central bank digital currencies there, and specified electronic money products will be reported under the old regime CRS, automatic exchange of information. So we exclude that from CARF. And we also have something else which, well, if something is not used for payment and not for investment purpose, why should we report that? Why is the tax administration interested in that? So let's exclude it as well. Okay, the rules were written like this, and then people started asking questions, well, how do I need to understand that? Who gives me definition on what is now not needed for payment or investment purpose? Is an NFT used for investment or payment purpose? Is a token I can use on a computer game something I could theoretically use for payment or investment purpose? Those are quite interesting questions at the moment for which we don't have an answer yet. I had the pleasure to meet last week a representative of the OECD who was writing the standard, and they also have now realized, yes, we need to give more guidance, and they promised to issue more guidance until summer. So let's see what they come up with. I hope they will bring something, because if you look into the current rules, or maybe more hints how we can understand it, it really doesn't solve the problem. And sometimes one could say, well, why are you talking about that? It's a no-brainer. But I think if we have listened this morning to other speeches, and if we see how the market will grow of tokenization, we will see that this CARF thing will get huge. And it's also the view of the OECD that potentially this will replace the CRS reporting. Because if we go in time and have more and more tokenized funds and derivatives, we will see much more reporting in CARF rules. And therefore, the definition is now something in this third category or not is very important, because that would drastically reduce or make drastically bigger the reporting amount. So we really hope to get more clarity on that. Now, we have understand now who might have a reporting obligation. What type of assets need to be reported? And some of you are representatives of banks who already need to do reporting under CRS, right? We are used to report the year-end value. Matthias Staubli has 5 francs on the bank account and received 1 Swiss franc dividend. Very nice. That's reported year-end. Now, under the CARF rule, we are changing the logic. We are reporting on a transactional basis. And we need to report that on the type of transactions. So we need to report Matthias Staubli did a crypto asset to fiat conversion, or we had crypto asset 1 into crypto asset 2. We need to calculate the fair market value. Another very interesting question: how do I bring in the fair market value in certain transactions? I don't have an official answer yet. I have some ideas, but not 100% clarity. Then retail payment transaction. If I'm going to buy a new car with crypto asset, it needs to be reported. Something which would have never been reported under the CRS rule. If I'm going to buy a car with Swiss francs, who is going to report that? No one. But if I buy it with crypto assets, it's going to be reported. Interesting. Airdrop, staking income will also be reported. So that gives the tax administration a complete new granularity of information, which they will use to introduce new taxation models for the future. We also had this in the morning. The question was, well, is technology following the law, or is law following the technology? In the tax space, it's very clear. Taxation is always 5-10 years behind. The tax administration, they see something like, oh, we might tax something, we don't know why. Let's get some information to have an understanding. And for me, that's clearly something in this area. So we see that the reporting is very granular. And that's difficult, because we need to collect that data. We need to be able to transform it, to work with it, and to report it to the tax administration. It's a complete different ballgame to compare to a CRS or a FATCA reporting. And for those of you who have the pleasure to become a crypto asset service provider and might have not yet had the pleasure to be an FI, a reporting FI under the old rules, you need to do due diligence. you need to document the users with a so-called self-certification. And we now see in Switzerland, the law has now finally been drafted, it's now in the parliament, and there has been a very not so nice surprise in the final version, which is now going into parliament. In the draft, it was not in there. It's if you have a pre-existing user. So if I today would be a user of a platform, of a service provider, as of next year, when the rules going live, I will be regarded as a pre-existing user because I was a user before 2026. I would need to be documented within 1 year. If I do not provide a self-certification, you need to block me. That's something completely new. We have never seen that in FATCA nor in CRS. If we talk about pre-existing old clients, old users. And that's for me kind of a negative surprise and something I don't really understand yet because I think here Switzerland is going further than what OECD is requiring, which is something I really don't understand why. But nevertheless, those are the rules. They need to go live January next year. Every client which gets onboarded as per 1 January 2026 needs to be properly documented. Now, what's to be done at the moment? What do we see? What are others doing? What are we supporting clients with? What should be the key takeaway from today? I think the most important point is the first one up there, gap analysis. You need to understand where do you stand at the moment. Are you affected by this new regulation? Yes or no? If yes, to which extent? And it's sometimes not very easy to say, yes, you are a new reporting entity. It really depends on the details of a service offering. So that should be really analyzed now, because after that, the whole wheel needs to go through. We need to discuss about how do we work with the data? How do we get the structured information of all those transactions? How do we get a fair market value? How do we bundle them? How do we put them into the different baskets? We also need to think about how do we work with the client data? How do we identify the client? How do we store that data? How do we work with changing circumstance? Maybe today I'm living in Switzerland. I don't need to be reported. But tomorrow I could move to Germany. If I have a Swiss crypto asset service provider, they need to report me. They need to realize that. Those processes need to be implemented. We need to think about technology and also data governance. But all those discussions can only start at the point I know whether I'm affected or not. That's why I think the key takeaway today is look into those rules, look into the regulation, ask yourself, could it be that we might be affected by it? Because what is really not nice in this regulation is that we need to report transactionally, which means as of January next year, I need to start collect the transactions. I cannot end of year start to look into my system and say, oh yeah, he has 0. whatever Bitcoin on the account. That would be too late. Now, what's also important, you need to think about, do I have different locations to cover? How do I understand what might be the differences between Switzerland and Germany, or Italy and Switzerland, or Dubai and Switzerland? Because sometimes the definitions, they might be different. In particular also for what type of crypto assets are required. And somehow you need to collect that information. And in the end, you need to develop a process which includes client identification, risk management, due diligence, reporting, KYC. We have now also the point that you need to train the staff. You need to have proper due diligence. If you are already now a traditional bank, that might be just an additional add-on in the reporting space, a very complex add-on, to be honest. Also some cobblestones with the documentation, but it's doable. If you have not done yet the reporting, it's a complete new ballgame. I hope I was able to give you a first impression in what is CARF. And I also hope I did not make your afternoon bad. And still, I'm happy that so many people sitting here after a great lunch, and thank you very much for your time and a great afternoon.